Consumer sentiment report is out today, showing a slight decline in February from the month before. For more on the latest figures, I want to bring in Sound Planning Group CEO David Stryzewski. David, welcome back. What's driving how Americans are feeling about the economy? The sentiment was on the rise, and now we're seeing a decline in February. What's that about?
Well, the consumer is not doing exceptional right now. I mean, in spite of what is, kind of a positive report. I mean, it didn't slip too far backward right now, but yeah, it did reverse. And in fact, I would just even note that on Tuesday, the Conference Board released their information on the consumer sentiment, and it was actually a further decline than what we're showing here in this Michigan version. So things seem to be tapering right now. There's a lot of debt. I think that as we look at our geopolitical landscape and the fact that we're talking about our government being shut down right now, that doesn't really bode very well for our confidence in things. The only reason why I think that things are maybe as high as they are right now is that, the market is at record highs. So, sentiment should be there. I think, though, the challenge is that most Americans are not, participating in these massive rises inside of the market because they're just trying to figure out how to feed their family, keep shelter over their head.
Yeah, well, personal consumption expenditures and the consumer price index both increased recently. Why did that happen, and what does it mean for the Federal Reserve?
Well, these definitely represent a bump in the road to the Fed's plans here. And just to back up 2 seconds, it was about a month ago that we were expecting 7 different rate decreases this year. And of course, the market's been rallying on that, now down to 3, maybe 4. So we haven't seen, I think, the pullback that probably warrants as a result of this. But no, the Fed's not going to be able to drop rates when we're seeing this high of inflation. Inflation surges as a result of printing money. And as we continue to print at about $1 trillion of deficit every single quarter, then, the question is ultimately, will inflation be going down? No, that's very inflationary to continue to print like this, spend like this. And ultimately, we see parts in our economy that are doing well, but many parts of our economy that are not doing as well, including every single one of the forward-looking indicators are actually all blaring warning signs. So I know a lot of my peers today are saying, hey, the Fed's, doing great. It's going to be a splashless landing. But those are the ones that are relying on rearview mirror data.
Mm-hmm.
That's a weird way to be driving the metaphoric car. I like to look through the windshield here, and it gives us a little bit better expectation.
Yeah, I think consumers were hopeful that there were going to be interest rate cuts soon, but now they're a little bit worried that might not happen. Maybe not as many as we anticipated or as soon as we anticipated. So we're keeping a close eye on that. And then the interest rates staying higher than longer. How might that be affecting the markets as well?
Okay, so this is where it all comes down. This is the $1 million question. Our entire system is based on credit. I know whether it's the borrowing that we're doing to afford life right now, or it's just the fact that every single business and every industry leveraged up as much as possible when we were back getting 0 interest rates. And so if we look at where we are today as a nation, there are many corporations crying out, screaming at the top of their lungs if they can, to say we need lower interest rates. And the reason for this is because, when we have higher interest rates, it costs a lot more to buy houses. Housing's more unaffordable than ever before. But my biggest concern right now is what's about to come in March, as we're getting to the end of the 1-year anniversary of when Silicon Valley Bank and Signature Bank all went bankrupt in that very short time frame because of the challenges that we're seeing with interest rates. So the Fed flipped the system. The whole world is in distress right now. And one warning that I'll just note is this. It's a basic accounting function, but most of the debt that we have coming due corporately in the United States is going to come due in 2025. Well, what's important to understand about 2024 is that this accounting rule, that once you get within the last year of when that loan comes due, that becomes a current liability, where that was a long-term liability before. Is that going to affect the balance sheets of these corporations? Absolutely. How's that going to affect the banks right now that need to metabolize all this debt? They're going to have a very difficult time doing it, especially because the Treasury pays so much and is essentially in competition with bank deposits, remaining balances there in those institutions. So yeah. I think that we're going to see over the next couple of quarters a little bit more of the challenge come forth here because of those higher interest interest rates, and I don't think they're cutting them as fast as people want.
All right, which could be a politically problematic for the current Biden administration. We'll have to wait and see. David Stryzewski, Sound Planning Group, thanks for your time today, as always.